Hello, good morning guys. Welcome to our weekly webinar again. Today we have quite a full lineup for you, and I'm going to kick things off by touching on the results of First REIT and FCT, who announced their results last week. So first off, I will talk about First REIT. First REIT, as we all know, the hospitals are all on very long leases. They're all on 15-year leases plus 15-year options. So rentals are fixed every year, and rental escalations are pegged to Singapore CPI. So with such long leases and with fixed rentals, you can expect not much fluctuations to the revenue. So we look at this brief summary of the results. Gross revenue actually increased 7%, but that is primarily due to the acquisition they did last December. So some of the key takeaways for the results and what investors should expect for First REIT is that, because as I've said, the rentals are actually pegged to Singapore CPI. Rentals are in Sing dollars, right? So there's no exposure to forex fluctuations. But escalations are pegged to Singapore CPI. And as we know, for the first 2 months this year, Singapore CPI has been in negative territory. And according to the latest MAS policy statement, they expect the Singapore CPI to stay negative for the entire 2016 as well, primarily dragged down by housing and private car expenses. So with this negative CPI projection, investors should expect little organic growth in base rental for the Indonesian properties. And then for First REIT, the debt headroom stands at 60 million after the latest acquisition. And historically, every year, First REIT tends to do acquisitions between the size of 40 to 70 million. So our investment action for First REIT would be to accumulate, and this is a downgrade from the previous rating of buy, despite our dividend discounted model derived target price of 138 unchanged. And this downgrade is because of the recent price appreciation. So the potential return has dipped below 20%, which is the cutoff between our ratings of accumulate and buy. So we think First REIT is still a stable yield play for its resilient income with long leases and minimal exposure to Sing dollars and IDR fluctuations. Next, I'll go on to Frasers Centrepoint Trust. For FCT, the big event for this company is that we know that the renovations, or so-called the AEI, to North Point is a big process, is a long process. It started in March, which would then hit the latest quarterly results. So the AEI actually brought down occupancy down to 92% as at 31st March. So that is actually down from 97.1% previously. Sorry, there's a typo here. This one should be the previous quarter. So this one should be December, 31st December. So the renovation works has actually brought occupancy down, and that in turn affected gross revenue down slightly 1% for the latest quarter year on year. But if you notice, despite this dip in the gross revenue, distributable income is actually still up 6.7%. And this is in line with what we have touched on in our previous report. Management has stated that they will strive to maintain DPU growth despite the renovation works. So there's this controllable option that they have in terms of the management units that they can take in cash or in units. So for this latest quarter, they're taking a higher percentage, that is 50% of the fees in units instead of in cash. So when they do such a thing, then that actually frees up more cash to be distributed to unit holders. And so that's why you see this distributable income going up despite gross revenue going down. And as for operational updates, we see that most of the malls are relatively stable, except for North Point due to the AEI as mentioned. And Bedok Point has improved from from the 76.8% we saw last year end. And this is because there's this gym operator which started in March. And according to management, there is another anchor tenant that is going to move into one of the top levels over the next few months. So management still expects the occupancy to be volatile at Bedok Point, but I think we could have seen the worst for Bedok Point already. And okay, I'm going to talk about the North Point AEI a little bit more, because this is the big event that is affecting Fraser Centrepoint right now. So this AEI actually started in March, is slated to end in September next year. The capital expenditure for this project is estimated at 60 million. So the primary function of this AEI, apart from to spruce things up at a mall which looks pretty jaded at the current moment, is also to facilitate the linkage of the current North Point here, the current North Point is this purple slot here, to the future North Point City which is coming up. Okay, so what they're doing to the mall is that they are reconfiguring some of the shops here. They are readjusting, let's say, the position of the escalators, the shops around here, and then they will set up a new walkway to link the two malls. So post AEI, right, actually the net lettable area will drop slightly, 4%, but then the quality of the retail space existing actually improves, because due to the reconfigurations of the walkways and the redesigning of the pathways, there is now actually a higher amount of footfall that can be directed past the shops. And when you have retail space that are exposed to a higher amount of foot traffic, you can actually collect a higher rent from the retailers if they are able to do better sales from the increased footfall. So with that, despite the fall in the NLA after the AEI, management is expecting a 9% increase in rental rates for North Point after the AEI. So for FCT, we had a target price of $2, and at the time when our report came out, the price was $2. So with that, we are downgrading our call from accumulate to neutral, and our target price remains at $2. So with that, I'll pass on to Gong Zhi to talk about CAO's results.
Hello everyone. Last week, China Aviation all released the first quarter result, which was quite extraordinary. Now let's look at the top line. The revenue actually dropped by around 30%. It's mainly due to the plunge of oil price over the past years. As you can see here, this quarter's average jet fuel price was $44 per barrel compared to last quarter's $73 per barrel. While the gross profit increased substantially by 1.5 times, according to the quarterly report, the growth was mainly due to large gains from trading in jet fuel and other oil products. However, we assume that it was mainly due to the paper trading, as the management from CEO previously mentioned that paper trading was the yield and margin enhancement tools. The operating profit almost doubled. However, the recovery of money issued from MF Global dropped from 31 million in the first quarter to last year's first quarter to $1.1 million in this quarter. CO's business was bottom line driven. The main driver of net profit was from the share profit of associates and joint ventures. In this quarter, the profit increased by more than 50%. And as expected, the Shanghai Pudong International Airport was the main profit contributor. Its profit went up by 46.5% to $12 million. And meanwhile, OKYC, the Oil Hub Korea Yuso Corporation, increased the share profit by around $1 million. And the total trading volume amounted to around 4.9 million tons. Totally, it went up by around 22%. Let's look at the breakdown here. The main growth from this total trading volume was from other oil product trading. In this quarter, it went up by around 67% to 1.9 million tons, while the jet fuel trading volume grew moderately by 4.2%. So continuously, the net profit, the $25 million net profit met 35% of our full year's expectation of $70.5 million. So you can see the chart here. Traditionally, the first quarter results, the net profit are stronger, showing the apparent seasonality. So over the past 5 years, the first quarter's net profit took up more than 30% of the full year's results, except the FY15. So the surprise fall of the net profit last year was mainly due to the fall of oil price. So we maintain our target price at 92 cents, and the last close price was 91.5 cents, which was quite close to our target price. So we downgrade from accumulate to neutral. Okay, now let's pass to Richard to talk about.
Hi, good morning. This is Richard speaking. So last week, Cash Logistics Trust announced their results for the first quarter. We published the report this morning. So the title report is Stark Disconnect Between Portfolio Growth and DP Return. So you see what I mean. Okay, to start off, we have maintained our reduced rating for Cash Logistics Trust. Target price also unchanged at 78 cents. Our forecasted DPU for this year will be 7.68 cents, and that would give 8.6% yield. Last close was 0.89. So let's go through the results line by line. So for the gross revenue, there's an increase by almost 33%. This is mainly due to the contribution from the 6 warehouses that it acquired in Australia last year. 3 were in the first quarter and the other 3 were in the fourth quarter. There's also contribution from their DSC Up, which is a DHL Supply Chain Advanced Regional Center. So these 7 properties altogether contributed 25.2% of GRI in the first quarter of this year. So going down the line, next is the net property income. You see that it grew by 12% year on year compared to the gross revenue, which grew by 33%. So this 12% increase, of course, was first due to a higher gross revenue, but this was offset by higher expenses associated with the conversion of 4 master leases to multi-tenancies. This happened last year, so there was added cost for the portfolio, and distributor income also was higher due to the higher NPI, and it was offset by higher financing costs. But this includes also a partial capital distribution of 1.65 million. This is the divestment proceeds from the Kim Heng warehouse that was divested in June last year. And lastly, the DPU actually dropped by 5% year on year due to the larger unit base. The unit base increased by 14.3% year on year. So we have 4 bullet points, successful renewals and new leases. So during the quarter, they had some renewals and new leases. So 22% of the lettable area that was due for expiry during FY16, these were renewed or they had new leases. But due to the current softness in the market, we believe that these were done at slightly negative rental reversions. Second point is the portfolio diversification to Australia. So now their portfolio, by portfolio value, their Australian properties make up 13.1%. 13.1%. In terms of gross revenue and net property income, it's 19% and 14% respectively. So for those of you who might be thinking about the forex exposure, so currently for their NPI that's denominated in Australian dollars, half of it for FY16 has already been hedged into Sing dollar. Yeah, and then next bullet point, long portfolio WALE. Okay, so portfolio WALE of 4.3 years actually is quite long. But the thing is that if you look deeper in the actual lease expiry profile, right, this year they're having 2 master leases which are expiring. And then in 2018, early part April, that is second quarter of 2018, there's going to be another master lease that's expiring as well. And all this is happening when the market is soft and there's a large supply coming in. So large supply coming in 2016, 2017, and the unabsorbed supply might cascade into 2018 as well. So there's some concentration risk all the way up to 2018. Okay, then the other thing, the last bullet point where talk about the Australian portfolio. So the Australian portfolio really came with additional costs. So if you refer to our report, right, you'll see that although the gross revenue increased by 33% here, top line, gross revenue increased 33%, but a lot of costs had increased disproportionately. So I'll just go down the line. So net financing cost, right? They had to increase debt in order to purchase these properties. The net financing cost has increased by more than 100% year on year, right? Managers' base fee also increased by 8%. Performance fee increased by 12% year on year, and the tax that they are paying now has increased by more than 600%. This tax is the withholding tax associated with holding the Australian portfolio, and then they have to pay additional trustee and custodian fees as well for their Australian portfolio. So bear in mind that for this cash, their manager's base fee is a function of the total AUM, and the performance fee is a function of NPI. So you can see that yes, the portfolio did increase, that's why the manager got a higher base fee. NPI also increases, that's why the manager has got a higher performance fee, but that did not accrue down to the bottom line in terms of DPU. Yeah, so to conclude, we still maintain our reduced rating for cash target price unchanged, 78 cents. Now I'll hand over to Peter, who will talk about Cinemas Land.
Good morning, everyone. I'll be touching on Cinemas Land. So we start off with the 2015 results summary. Revenue was up 15% to $957 million Sing dollars, and that was because of higher land sales and handovers of shophouses and residential units in this township called BSD City. Next, there was gross margin compression, slight compression from 72.1% to 68.7%, and this was mainly because of the higher infrastructure costs for certain industrial land plots. Next, at the PBT level, because of absence of contributions in 2014 as well as slightly higher financing costs, profit before tax dropped 16%, and right at the bottom line, profit after tax dropped 41% due to the higher non-controlling interest from the spinning off of Pura Delta Lestari, which was listed on the Indonesia Stock Exchange in May 2015 last year. Now, we go into the Indonesia property segment. So, at this point of time, majority of its revenue is still coming from Indonesia, and it will carry on that way for a long time to come. So, sales of development properties and land make up of 84.1% of its the entire group's revenue, followed by rental income of 13.2%, and the others are a small area. And the primary driver for the sales of properties are still mainly from the 2 out of the 4 townships that they own, which are Bumi Serpong Damai City and this Kota Delta Mas. Just from these 2 projects is already driving 70% of the group's revenue. And if you include the sales of development projects outside BSD City and Kota Delta Mas, this forms 91% of the group's revenue in Indonesia. And now we move on next. We can dissect the company just by looking at 3 of these listed subsidiaries that Cinemas Land owns. The first one we're looking at is Bumi Serpong Damai, or the stock code is BSD.JK. The last closing price was Rupiah 1,945 as of 21st of April. So if we work it out, market capitalization is around 3.8 million Sing dollars or so. While some people might not have heard of BSD, but may be more familiar with Lipo Karawaci, and which is the sponsor of First REIT. BSD is almost twice the market capitalization of Lipo. Now in 2015, marketing sales target, they managed to meet 90% of it, amounting to 6.8 trillion rupiah. So you just take an exchange rate of 1 Sing dollars to 10,000 rupiah, you get around 618 million Sing dollars or so. And the shortfall is mainly due to the delay in 3 projects. 2 of them are here. These are the artist impressions of these 2 property projects, Apartment Tanjung Barat and Arium. Next, marketing sales in 2015 were still higher by 3.8% year on year. In 2014, it came in at 6.5 trillion. And more importantly, the sales were mainly driven by higher pre-sales in residential properties, where it accelerated 39% year on year to 4.4 trillion. And out of these total marketing sales, majority of these residential property sales still comes from landed properties. And this is because of the consumers' preference, who are still leaning towards the landed properties as compared to high-rise establishments. And then again, just before we go into the next slide, I'll just share a bit more about these 2 launches. This Apartment Tanjung Barat, based on my own estimated gross development value, it should come close to around 2 trillion or so. And for this development, let's just assume pre-sales of probably phase 1. Let's say you just launch one condominium tower, and we just half that figure, you get around a trillion rupiah. Then for the second project, this is a large-scale mixed development project, which is occupying 5.4 hectares or so of land space. It's a mixed development consisting of residential, retail, hotel, and some offices. So again, if you just take the condominium units out, that's probably going to contribute perhaps around 500 billion rupiah. So all in all, if you just add on that contribution from the first development plus the 500 trillion, the 500 billion that we just talked about, you get another 1.5 trillion, which I think is pretty sizable, and that will have closed the gap for the marketing sales target that they have initially targeted for. Next, these are just some projections for BSDE. So for them, they're targeting for 6.8 trillion. We think that this is achievable because of the still rather strong residential sales that they are still experiencing on the ground, and out of which 30% of the contribution will still be coming from BSD City, which is the largest township that they own. And on top of which, including those projects that were delayed, we should see sales coming back or coming close to where it was in 2015. And just before I move on to the next slide, I would also take some time to talk about the economic reform packages that the Indonesian government has introduced since September 2015. So between September 2015 to February 2016, a total of 10 economic reform packages were actually introduced. Well, we'll not go through everything, but there will be a few that I'll be touching on in the next few slides. So the reason why I bring up is that all these 10 economic reform packages are to target and to boost FDIs going forward. So in short, when FDIs when there's an inflow of FDIs, we should expect increase in demand for real estate going forward. The second lease co that Cinemas Land own is Pura Delta Lestari. So this was listed in May 2015 last year. Cinemas Land owns 44.5% of it, and if you just take a closing price of 205 rupiah, this works out to be around 1.2 billion or so in market capitalization in the market cap. And for last year, in 2015, they booked in 1.7 trillion in marketing sales, and this was mainly from the sale of 90.5 hectares of land area. This was the total land sales total industrial land sales in Indonesia was much lower as compared to 2014 because of the uncertainties in the global economic environment. But however, in the whole of 2015, only 350 hectares of industrial land was sold. And if you just take 90.5 hectares out of 350, essentially they have sold 25% of the market. And now there will be the government has introduced two of such economic stimulus packages. First is the 3-hour licensing policy, because traditionally in Indonesia, for any permits or legal work, there will always be, or put this way, there will always be a long processing time for works to go through. It can be as long as probably a few weeks to even months. So now, in order to cut down this red tape and to increase efficiency, they've housed everything under one roof. And second thing that they have done is to introduce a new minimum wage policy that will grant certainty in cost visibility for businesses, and all of these are part of the moves for the government to boost FDIs. Now, we think that the growth in demand for these industrial land plots will be driven by, or expected to be driven by, the demand will continue to be driven by three drivers. So first thing first is the new land supply that can be used for industrial purposes is very scarce, and this is especially the case for in Bekasi and Karawang. Next, the increasing growing number of companies that are operating in the eastern region of Greater Jakarta is also um, um, one of the reasons which is making the demand for these land plots to grow. And more importantly, next the other factor is that there is a growing middle income population. Although these economic reform packages have already been unveiled by the government, but we have to acknowledge that it takes time for these for them to take effect. And for that, we think that in 2016, industrial land sales will continue to be weak. But at the same time, we are encouraged because these developers are not cutting prices in order to meet their sales target. So to some extent, I would say to a reasonable extent, the developers are still have conviction in the underlying land prices. So I'll just bring everyone's attention to the two charts below here. The two places that I mentioned, Karawang and Bekasi, these are the two places where majority or large proportion of Cinema's land bank are in. So if you just look at the black and red line, they are commanding a higher valuation relatively to the rest of the regions. So other regions like Bogor, Tenggarang, and Serang, land prices in Karawang and Bekasi are definitely much higher. And the second figure actually shows the land absorption rate in 2015. For Greenland International Industrial, this is the 50% owned subsidiary of Cinema's Land. They are the, if you just look at the chart, they rank second below Modern Chikanda, but that's because of the higher land sales. The much higher land sales is mainly going to one customer. So if you normalize it, GIIC or Greenland International Industrial would have topped the charts too. So in just 2 months ago, in February 2016, Cinema's Land has actually announced plans to develop a 228-hectare integrated residential and mixed-use development. So according to them, this is the first of its kind. It has a 18-hole international golf course which runs along a 1.2 km long beachfront, and the close proximity of Batam to Singapore and certain regions in Indonesia makes it ideal for Singaporeans or Indonesian citizens to come for a premium vacation while still being near to home. And the group is expected to invest a minimum of 4 trillion, which is around 400 million Sing dollars or so, to develop Nuvasa Bay. Or Nuvasa Bay is the development that is the name of this new development, and will be developed over 3 phases for a period of 15 years. The pre-sales for the first phase, which includes 2,500 resi and condominium units, will commence by the 4th quarter of 2016. Now I move over to the UK. Over in the UK, Cinema's Land owns 2 buildings. First is Alpha Beta building, and the other which is Warwick House, but we just place our attention on Alpha Beta building because it was a recent acquisition that they have made last year in October 2015. So this is a nice story building. It has a net leasable area of 247,000 square feet or so. Currently it's fully occupied, has a weighted average lease expiry of 13 years. And tenant mix of the buildings comprises mainly tenants from media and technology industries. And the actual site location of the building, just diagonally across the street, are famous media companies like Bloomberg. And just directly opposite Alpha Beta building is actually the London Mercantile Exchange. The building is located in Shoreditch, which is still residing in Zone 1 of Central London, and is well connected to by 2 train stations, 200 meters walk away from them. Now, Alpha Beta building actually replaced rental contribution from Newbrook buildings. Newbrook's building, sorry, there's a typo error here. So it was divested in 2014, but the inclusion of Alpha Beta building has actually lifted its gross profit. I mean the entire UK segment's gross profit due to its triple net leases, triple net lease that are signed with the tenant. So for triple net lease, for at least how it was signed in the UK, the heavyweights or the heavy components that are coming from insurance and maintenance of the building. And lastly, for Alpha Beta building, there could be a potential increase in net leasable area in the future. There is still around 5% or so of unutilized net leasable area, which we think that the management will eventually open it up to lease out this space. Next, for UK properties, we expect further margin compressions to both of these buildings, and this comes from 2 factors. First, low supply and vacancy rates of prime offices across central London. Next is that there's almost no construction activities of offices across London, meaning that there will not be much new supply coming on stream in the near term or so. However, we think that compressions are unlikely to be extensive because cap rates in London are already at a 10-year low. So if this trend is to carry on like this going forward, we expect the valuations of these 2 buildings to benefit. And other noteworthy developments in 2015 is that they have been aggressively buying back their shares. 290 million shares around there were bought back just in 1 year itself in 2015. And the total number of shares bought back to date was 7% of the total outstanding number of shares. Next, the share repurchase mandate has been renewed in the recent AGM, but there is a cap towards how much more they can buy because according to regulations, the amount of shares that can be held as treasury shares is capped at 10% of the total number of outstanding shares. Right now it's really standing at 7%, meaning that there's only around 3% sold to go. And lastly, this subsidiary Pura Delta Lastari was listed in May 2015, which I've mentioned before, and it owns and operates one of these township developments called Kota Delta Mas. And if you include this BSD, DUT, and DMAS, all these 3 listed subsidiaries, you get a market capitalization of 6 billion as of the closing price of 21st of April 2016. Now this is the RNAV table. It's broken down for the Indonesian properties as well as the properties in the other regions. For just to keep this simple, for land plots or land banking, valuations are given a 35% discount. This includes BSD. This is the entire land banking segment for the BSD subsidiary, and the rest of the land, which includes some golf assets, these are all lumped others into this land segment as well as the other segment. So all in all, land are all given a 35% discount, and for office, commercial, and hotel properties, they are given a 15 to 20% discount to the RNAV. And next, to moving overseas, so London, Malaysia, and Singapore, especially in London and Singapore, these assets are highly marketable assets. So in London, like I mentioned, the scarcity of Zone 1 offices or Central London offices make them highly marketable. And next is in Singapore. They own 9,000 square meters of orchard towers. So this is as well. This is also prime land property. I mean, like properties located in prime districts. So with that, we think that applying a 5 to 10% discount to both London and Singapore properties is justifiable. And if you total up the RNAV value, we get a value of around 3.4 billion or so. If we add in the projected cash in 2016, which is around a billion, plus taking the face value of associates and JV, subtracting away debt, you get RNAV of 3.4 billion. When you divide this by the outstanding shares, you get RNAV per share of around 79 cents or so. And there was no discount applied to the RNAV because Cinemas Land is trading at a 23% premium to its book value. As at 31st of December 2015, Cinemas Land has more than 7,000 hectares of land bank remaining. So to put this into perspective, 7,000 hectares is equivalent to 70,000 square meters. And to bring this into context, 7,000 hectares is around 10% the size of Singapore, or as big as the Bedok district in Singapore. So this is just to give people a sense of how big 7,000 hectares of land bank is. And out of these 7,000 hectares, 1,700 of hectares are 7,000 hectares of this land belongs to the 4 large-scale township developments of the group. I will not be touching on into details of these 4 townships, because I've actually included the details in the appendix section. So if you have, I will urge everyone to just have a look at it instead. Now, why am I stressing on this land bank is that the rich amount of land bank, it allows the group to capitalize on further development opportunities, and more importantly, to unlock this value of the land. Furthermore, some of this land were pretty much very dated. It could be acquired 30 years ago, since 1984, meaning that land acquired 30 years ago are definitely much cheaper as compared to acquiring land in recent times. So if you do recall, in 2015, gross margins are around 60%, 68%, 70% in 2014. And compared to a Singapore developer, this is superior margins that cannot be found anywhere else. And lastly, we come to we maintain a buy, but with a downward revision in our target price to 79 cents. And the downward adjustments were mainly from the assumptions and estimates that were revised from the previous analysts. And for that, I've come to the end of the presentation. So if any questions, please feel free to ask them.
There's some, okay, this is Richard speaking. Yeah, there's one question, why are various REITs expanding Australian properties? The main reason is Australia is freehold land, so unlike Singapore, so if you I'm talking specific to the industrial REITs. Currently, if currently the industrial land JTC gives it out for either 25 years or less, now even maybe only 15 years, whereas for Australia the land is freehold. There's a question on cash on the estimated DPU. So that's how is the DPU of 7.68 cents of FY16 derived? So it's from our estimates, and DSC up will has already started contributing to the GRI this year. Um, so if you go back, let me go back to that slide. Yeah, so okay, the question is, wouldn't the DSC asset contribute increasing GRI this year? Yes. So it's already contributed in here. So 25% of this 27.8 consists of the 6 Australian properties and the DSC ARC. I believe the question also is asking about why isn't the FY16 revenue higher. Don't forget, actually last year there were 4 conversions from master leases to multi-tenancies as well. So that also will affect this year's GRI.
Hi guys, Rohan here. There's a question on first read, and the question is that how much is their debt, and how will potential increase in borrowing rates affect their financial situation? Will they issue bonds in place of borrowing from banks at probably higher rates? And then, okay, the thing about first read now is that when it comes to the debt portion, they have options. They have done bonds before. The current proportion of the total debt is about 22% is from bond issues. So I wouldn't rule out them issuing more bonds to raise more debt, but then it depends on how the internal finance team and how the interest rates at current moments, or at the interest rates at the point where they spot acquisition targets, the rates at that point in time. So it is a very fluid, a very dynamic situation. It can be either way, but I think what is more important to consider is the spread, is the return spread that the REIT is able to achieve. Because if you look at them historically, whenever they buy a new hospital from their parents, the yield that they're getting, the rental yield that they're getting is usually upwards of 9%. It's 9+%, 10%. So with this kind of yield that they're getting on their acquisition targets, it is not difficult for them to get an accretive yield acquisition over whatever cost that they're facing, and to achieve the 4 to 5% yield spread that the management is targeting. So another question on the same counter as well. that the NAV, the price to book now is pretty high. It's about 1.2. So are there better options around? I think typically healthcare REITs tend to trade at higher premiums to book because of the stability that they offer. Because if you look at P Life REIT as well, Parkway Life REIT now is even at an even higher valuation. The PB is about more than 1.4. So in return for the stability, because when you compare to offices and compare to retail malls, these hospitals are pretty immune to changes in economic conditions. And what's more, first REITs leases are all fixed for 15 years or more. So these are the kind of stability that they offer, and this could be one of the reasons why investors would be willing to pay a higher premium in terms of the price to book. So question for Fraser Centrepoint. The question is that the question is on the Malaysia exposure for the REIT. And then the second part of the question is that North Point and Causeway Point always seem to be the main driver of earnings, mainly due to the monopoly of those two malls in their respective locations. And then this our client also noted that FCT seems weak when standing against competition, such as Bedok Point versus Bedok Mall. And then he pointed out that there's URA data released last week showing increasing retail space vacancies, and how would this affect FCT's DPU going forward? And this client also compared FCT with the sister REIT, Frasers Commercial Trust, because now FCT is trading at about 1.08x PB, yield is about 5.8, whereas Frasers Commercial is about 0.85 PB and 7.5% yield. Okay, I'll go through them one by one. First off, Malaysian exposure. Malaysian exposure is really small. It's less than 5%, maybe just 3% of the total exposure of FCT. So there is weakness in this income coming from this Malaysian side recently on the back of weaker ringgit. But then we are not too concerned about this because net the effect is very small, because the overall exposure to Malaysian properties on FCT's balance sheet is actually just about 3%. And you're right in saying that the North Point and Causeway Point, they are the main drivers of the earnings. They are the two anchors of the entire portfolio. And in fact, they're really the pillars of the portfolio. And I think Bedok Point is weak. There's no doubt about it. But I think with regards to the other malls, you see, if you look at the two main anchor malls, historically they are always very stable, except for times like this for North Point or for Causeway Point when you're doing AEI. Occupancies is always 88%, 89%. There's no competition there now, and there wouldn't be any competition in the near foreseeable future. So these two malls will still continue to drive earnings. As for the other malls, I think Bedok Point is weak, and it is an in process readjusting of the tenant mix that the management is trying to achieve. I have no idea when or how long it's going to take, but it looks like we could have already seen the bottom, because there's a new anchor tenant in the gym which came in last quarter. There is going to be a new anchor tenant which is coming in this 2Q calendar year 2Q. So the next results, you should see occupancy improve further for Bedok Point. But that's notwithstanding the fact that current tenants may still terminate their leases. Okay, so I think the only concern now is Bedok Point. Changi City's point weakness, I would say, is more transitory than structural, because they are currently affected by the MRT works. And once that is complete, I think that the hangover on that mall should clear. What is next? Oh, okay. Next is the URA data showing increasing retail space vacancies. Retail space supply is indeed going up for this year, but the thing is, a lot of this retail supply is in the suburban area, which is where FCT is operating, but not at the specific locations where FCT's main malls are, like Causeway, like Woodlands, Yishun. That area is actually pretty, the upcoming supply is not that huge. And for Yishun, maybe you have North Point City, and then for for the increasing vacancies, I think we have to note that the REITs in Singapore, they all own the best located malls in Singapore. These are the malls where Singaporeans congregate over the weekends. You look at the URA data, that one is data on the whole, for the whole island of Singapore, including all the private malls, all the private retail spaces. But these REITs, they actually own the best properties in Singapore around the island. So in terms of, I think they would be more insulated against all this rising vacancies. Because I think for a lot of all these malls, the waiting list for tenants wanting to set up shop in the mall is actually pretty long. It's just a matter of rates. And if you look at the malls themselves, if you look at retail sales, right? Retail sales for Singapore last year, it was weak. Retail sales for Singapore in the first 2 months of this year, it was weak. If you strip off motor vehicles, retail sales is actually negative. But if you look at CMT's retail sales, if you look at FCT's retail sales, they're still pretty resilient. They're up maybe 2 to 4% on retail sales year on year. So because of just by virtue of the fact that they own the best malls, the best properties in Singapore. So I think you have to look at the situation on a more micro level. Supply is going up, but where is the supply exactly? If it's not affecting my Woodlands area, my Yishun area, I think we're still pretty insulated. And as for the comparison between FCT and Frasers Commercial, I think you're looking at two different sectors of REITs. FCOT is a commercial REIT because they're more susceptible to changes in the economic conditions as compared to FCT, which is suburban, right, and it's more necessity spending. And for offices, it's a different story. You know, when economies go up, banks will overhire, and when it goes down, they tend to overfire. So the change is more responsive. It's more liquid. So there's a higher risk involved, and that explains a higher yield as well. So, and FCOT, they have Australian properties, which is not a small percentage. Okay, so there's FX risk there as well. So all in, you're looking at two different sets of dynamics, which would not be a fair comparison to say, oh, FCT is trading at a lower yield and a higher book value, which is why it should be deemed inferior to FCOT. And then another question is on, just now I mentioned about FCT, the management taking more in management fees in terms of units compared to cash. So in our projection, we actually forecast this year we forecast a higher percentage in units, but then in subsequent years, then the management will actually claw back and take lesser in management units when North Point is back standing strong again. So historically, management fees in terms of units is around 20%. For this latest quarter, they are taking about 50%. So as to whether this will dilute DPU, if you take the fees in units, you increase the number of units, yes, you dilute the DPU, but then you have to note that this increase in the number of units as a percentage is actually lesser than the increase in the percentage of the cash that you are able to pay out. So there will be a threshold point where if you take more in units, you actually dilute DPU. But for FCT's case in this scenario, the increase in the number of units is still not sufficient enough to dilute DPU because the increase in the cash that you free up as a percentage of your current quarter's distribution as a percentage wise is still larger. So net, it will still lead to a higher DPU because of what you're doing.
Oh, okay. There's this Richard speaking in. Why would cash DPU drop so low for this FY? So, uh, okay, going back here again. You take a look at this slide. So one thing is that in the fourth quarter of last year, they had this private placement, and so there was a very substantial dilution. Yeah, so you see there's a 14.3% larger unit base year on year already. And in my forecast, I've also assumed negative rental reversions on the master lease that is on the two master leases that are expiring in the second half of this year. And then don't forget the if it converts to a multi-tenanted property, it's the expenses is going to increase as well. So the thing is that same like what was in a I would say same but along the same lines. If the NPI increases or the distributable income increases, but there's a disproportionately larger increase in the unit base, then the DPU also does not accrue down to the unit holder.
If there are no other further questions, we'll just call it a day today. Do tune in again next week. Thanks, everyone.